All right. Hey, so I've got Tommy McWilliams with me today. Hey, Tommy, how's it going, man?
Hey, it's
So,
going well. How you doing?
Tommy Taxes, as we affectionately refer to you around the office. Tommy is our
Yes.
CPA and tax guy for not just me, but Jeremy and a couple other guys on the team too. So, thanks for your help. And
Yep.
I just wanted to run through just simply like I know there's not a ton, but there were a few changes last year regarding all the different things that homeowners could write off. So just wanted to talk through what are the tax ramifications of owning a home versus not owning a home, and then maybe some of the changes that we saw last year as a result of Trump's tax changes that he made. So what would be, if you are a homeowner, what can you write off, and what kind of changed that now you can't write off? Like, what are the big changes there?
So the biggest change was the change to the mortgage interest limitation. So before you could have up to a $1 million mortgage and deduct 100% of that interest as uh, as an itemized deduction on your personal return. In 2018, they switched it so that up to $750,000 can be used as your on your primary residence
Yeah.
as the qualified amount of interest, or qualified amount of principal for your mortgage interest deduction. So that was a huge decrease for a lot of people. It took away it used to be 1.1 because you could have up to $100,000 of home equity on top of that. And now it's just flat $750,000 for any new loans after, I think it's January 2019. So
Okay.
that's not a change from 2018 to 19 or 2019 to 2020, but it is the most significant change. The other significant change is the real estate tax deduction. In years past, you used to be able to take a deduction for all of your taxes, which would be your income taxes that you pay to your state, your real estate taxes that you pay on your primary residence, maybe real estate taxes on investment properties, personal property taxes on vehicles and whatnot. They put a cap on the total amount of taxes that you can deduct of $10,000, and that's hit people, especially on the West Coast in California, Oregon, not so much in Arizona because we have lower income taxes than you
Yeah.
guys do, but definitely people in California and New York and New Jersey, the high tax jurisdictions, it's affected them the most.
Yeah, and then the other piece is that because the standard deduction is higher, less people. It makes sense for fewer people, a smaller percentage of people, to itemize the interest they get on their houses, anyways. Is that right?
That's right. Yeah. So they raised the standard deduction for single people to $12,000 a year. It used to be, I think, 6,500 or something, much lower. 6,400, I believe, was the last year. And now it's 12,000 for single people, 24,000 for married people, and then that'll be adjusted for inflation every year.
So,
So if you don't have 24,000, let's say you're married, you've got a house. If you don't pay at least $20,000 of mortgage interest or whatever, you're probably not going to get to itemize your deductions, and then you're just going to use the standard deduction. So you won't even have to worry about itemizing anything. So it actually simplifies your taxes
yeah.
overall. But uh, and you could end up in a situation where you may have like a $50,000 or $100,000 of combined real estate taxes, state income taxes, and whatever. And because it's capped at 10,000, you still don't qualify to itemize your deductions because the rest of it is just not deductible.
Yeah. So is there a ballpark where a certain amount of interest you're writing off every year, or income level or whatever it is, where, hey, above this limit or above this number, generally it makes sense to itemize, specifically regarding housing? Like, at what point is itemizing going to make sense for people
Right.
in general?
So, like I said before, if you have at least $24,000 as a married couple of all of your itemized deductions when you add them together, so you could have up to $10,000 of taxes. So if you have $14,000 of mortgage interest, then as a married couple, you would want to itemize because you're already at that $24,000 limit. A single person, it's a much lower threshold. If it's only $12,000 for singles, and then head of household would be 18,000.
Okay.
But
Got it.
it's also depending on each individual's charitable, uh,
Yeah.
you know, habits. How much are they giving to charity every year? Some people tithe and they'll give like 10% of their income. Some people, don't do anything. So
Yeah.
that also changes the equation.
Yeah. Yeah, and then if one of the things you said too when we were chatting was that a lot of people, specifically people who just bought a house, miss particular itemization or sorry,
Right.
item they're able to write off. What is? Do you want to talk us through that real quick? If you
Yeah.
just bought a
So
house, what should you be thinking about writing off?
right. So when you close on your house, let's say you're buying a new house, you'll get a settlement statement with the closing, and it'll break down all the costs associated with closing, which would be, commissions for real estate agents, insurance, HOA, whatever. And then maybe if you paid any points, the points and the taxes that show up on your settlement statement don't show up anywhere else, and those could be potentially tax deductible in the year of the purchase. So
Yeah.
I always recommend people to take a look at their settlement statement or give their settlement statement to their CPA or their tax preparer. I just always ask for it whenever somebody buys a new house, because there are always things that are on there that could be deductible.
Yeah. Okay. And then this isn't as real estate related, but could you, as best you can, summarize? It seems like the people who came out a little bit ahead on these tax changes were people who own S corporations, right? People who have their own, they're entrepreneurs. They have their own businesses. What's the big picture there? Is there any way, or is there anything that people should be thinking through in terms of the way, if they're self-employed, the way they organize their income, or is there a way that certain kind of people can benefit from those changes?
There's really not much difference between the S corporation and a sole proprietorship on the pass through business income deduction, which is probably what you're talking. It's a 20% deduction of your net qualified business income. It's called a QBI deduction, and qualified business income is basically anything that's you're active in producing, and it's not rental income per se unless you're a real estate professional
Okay.
and you make an election to categorize it as qualified business income. But there isn't a whole lot of difference in the Trump tax changes between those two. Like they didn't say, oh, there's more benefit for S corporations now than there was before. I mean, S corporation I think they're more favorable hands down over just a sole proprietorship. I mean, it definitely puts a cap on how much you're going to be paying in Medicare tax. I mean, because on self-employment earnings, you have an unlimited cap on Medicare earnings, whereas an S corporation, none of the earnings are subject to Social Security, Medicare, like self-employment tax, the same as self-employment income is. So you can put a cap on your max Medicare wages. So if you're making millions and millions of dollars, that's going to be a huge savings.
Yeah.
But and even on that first 100,000, the difference between what you pay yourself in salary and what the S corporation makes uh, is is basically your tax savings. So multiply that by 15.3%. Let's say you make $100,000 with your business and you pay yourself 30,000. Well, now you have $70,000 of earnings that are not subject to self-employment tax.
Yeah.
So you're saving 15.3% of 70,000. Do that for the 10 years, you've got a sizable sum of money. So
Yeah, a lot of people. The reason I asked, a lot of people are doing side businesses now, right? Side hustles,
right.
economy, all that stuff. Where does it start to make sense to consider setting up a real business? Having a LLC, F corp, something like that. How much money
Right.
should you be making to start, wandering into that territory and consider that expense and energy?
I would say setting up the LLC, there is no threshold too small. I would say you could set up an LLC because it's such a flexible type of entity,
Yeah.
and it's very cheap in Arizona. I mean, I think it costs $50 plus a like $30 processing fee. Some states it's about $200,
Yeah.
but the actual LLC, just setting it up and getting that in place, you get a business bank account, and you've got some continuity. Over time you'll need that for credit worthiness and stuff like that. So uh, but after you reach about 30 to $40,000 of net income through that business, it starts to make a lot more sense to be the S corporation.
Yeah.
But under that, it's probably a wash because of the annual fees for preparing your taxes for the S corporation, doing payroll, maintaining the books, bookkeeping, stuff like that.
So to simplify it, it's, setting up an LLC is pretty simple. You can do that on LegalZoom. You probably can wade through it on your own even. You certainly have an attorney do it, but that's not rocket science. And then, so there's this LLC set up over here, which is what I have all my companies as. And then you can tell the IRS, hey, I want that to be taxed like an S
as an S corporation, right?
So it's called, I think, an S corp election. I think is what you call it. You just say, hey, the LLC is really flexible. It's really simple. It's really easy.
Right. Oh, it is. Absolutely. Yeah. It's you just file Form 2553 with the IRS. You can do it within the first 2.5 months of the first tax year. So if, let's say you started a business now, it's January 2020, you would want to file by, April, the end of April, because we're already at January 20th. We got 2.5 months to file in your first year. Or you can make a late election all the way up till the time you file your tax return for the following year for that first year. So you could make a late election under, I think it's Rev Proc 2013-10, where all you do is say, hey, I'm making this late S corporation election. You file the S corporation tax return with that business's first tax, or as if you had made the election on time, and they allow it. So just having the LLC set up from the get-go, it gives you that opportunity to, within the next year, if you look back after the end of the year and you say, oh, I should have been an S corporation that entire time, well, then you can go back and make the election late in that first year. So it just, that added flexibility.
Yeah, so what's great, and a lot of this is going to be potentially over people's heads, but I think the big picture idea is once you get above, if you've got a side business, you've got something you're doing, once you get above that $30,000 mark, probably worth talking with a CPA like yourself to make sure you set up the correct taxation.
Absolutely.
Potentially really save some money there. I know I've been
right
that in a huge way. So
yeah, most people, they think that they're spending money by going to a CPA, but you're saving money absolutely every year. Our services pay for themselves year after year. So every return where somebody tries to prepare it themselves, they're always making huge errors, and they have no clue. I mean, they're not dealing with it on a day-to-day basis, so they're not privy to all of the ins and outs, and it's complicated. So that's why you got to go to school and study tons and tons to figure this stuff out. It's not like something you just wake up one day and say, I'm going to start doing taxes.
Yeah, I mean, this is in my wheelhouse. I have a finance degree. I sell houses for a living, run a bunch of business, and it's just so over my head. It's crazy. So can't recommend getting a professional enough. So helpful.
Right. So is there anything else you wanted to talk about, John?
No, that's it. So I wanted to run through those two things, basically the housing taxation, and then since we have such a large portion of our clients who are in this kind of gig world where they're starting side businesses, talk a little bit through that. So that's great. If people want to get a hold of you, Tommy, what's the best way for them to reach out and have you help them out?
I would say email is probably the preferred method, and it's tmcwilliams@scottsdaletaxconsulting.com.
Cool. All
right. Yeah, shoot me an email if you have questions. Well, it was good talking to you, John.
Yeah, thanks, man. I appreciate your help, and hopefully some folks will reach out. We really appreciate everything for us. Have a good one, man. See you, buddy.
Yep. All right. Talk to you later.